Hey, welcome to this month's market update, everyone. I want to give you an update on what's happening in the market and quell those fears about the sky is falling and all the scary headlines we see all over the media, really. So I want to go big picture first, and then we'll talk more about local Orange County, Southern California, what's happening, what are the numbers. So obviously, we've all heard the Fed raised the rates again a couple of weeks ago, and that again, and we've said this many times before, but when the Fed raises rates, they're not raising mortgage rates, that's the interbank lending rates, but the bond markets are what moves mortgages. Anyway, the interest rates, the mortgage interest rates have gone up quite a bit over the past 10 days, 2 weeks since the Fed raised their rates. It's just the rates have gone up quite a bit. So if you were in escrow and you had locked your rates, you were a happy camper. If you're not, one of the things we are telling our buyers to do constantly is really check in with their lender on, are they still approved at the point that they thought they were or not? Because this changes quite significantly with the rates. But rates have gone up about a point, 1% over the past 2 weeks. And this has had an effect on the market, and it will continue to do so. The Fed has indicated that they will continue to raise rates. They're trying to fight inflation with everything they've got, and interest rates are the main weapon they have, and they are, going at it full force. This is going to raise mortgage rates for the foreseeable future until the end of the year at least. And so this is what we're working with. Now, this is not 2008, and this is not going to crash the market. It definitely has a downward effect on prices, on affordability, and all these things, but it doesn't necessarily mean it crashes the market. And this is very different. This situation we're in now is very different than 2008. People are sitting on so much equity. I was reading an article the other day, and it was saying that Americans now, the amount of equity they have, where the property values are, and the outstanding total loans they have is under 30%. So Americans have a ton of equity, okay? Most people. So, which is very different than 2008, when people were just getting into homes with fraudulent or very, not sound underwriting on mortgages, and they were getting adjustable rates and all these things, which is not the case now. So this is not 2008. With that being said, there are bright spots for the future, medium-term future of housing. The two main things are, there's still an undersupply of homes. Whether we're talking here locally, Orange County, Southern California, or big picture, the US, there's still an undersupply of homes. And number two, so that's the supply side. The demand side is millennials are they're becoming peak home buying age. So, and they are the biggest segment of the population now, behind baby boomers, but they are becoming this buying force. So there's a lot of demand upcoming and very little supply. So that's still good in terms of the outlook for housing, okay? Now, you'll see on this chart here, this is also, this is national, but this is a testament of demand levels. Demand is not falling like a rock. It will fall because, again, of the increase in rates that happened recently, and they're gonna go up again, and it is what it is. But you'll see that the showing levels, they're still above what the numbers were pre-pandemic. Last year and 2020 were, insanely high numbers, but you'll still see that the demand, the number of showings happening on average on a listing is higher than what it was in 2019 and before that. So that's a good indication of demand and where it is. Okay, now let's talk about affordability. Affordability is getting hit. There are three factors that determine the affordability, right? It's prices, it's interest rates, and it is salaries or wages. Okay, now this we don't really have any control of. Prices have gone up significantly over the past few years, and interest rates now are really the factor that's affecting affordability, because the higher the interest rates go, the higher the payment is for the same house or the same priced house. Like if we were talking 12 months ago, rates were below 3%. Now they're above 6.5%. So significant difference. So affordability is being hit right now. This will have a downward effect on pricing, but to what extent, still don't know. And we've also discussed this in previous videos. I've showed a chart about it, where when when the Fed and the government acknowledges that we are in a recession, they're gonna start dropping rates. So when rates start dropping again, this is gonna have a positive effect on affordability. Okay, now let's talk local numbers. Inventory is still pretty low compared to previous years, compared to pre-pandemic years also. We're right around 3,500 homes here in Orange County. For comparison, in 2019 we were above 6,000, 6,500. So very low inventory compared to previous years. Demand went up a little bit. You'll see on the graph here, it went up a little bit, it's falling down again. That's normal, and it's going to continue to fall even more dramatically towards the end of the year for two reasons. Number one is interest rates. The higher they go up, the less demand, because less people afford homes and so on. But also, this is normal of this time of year. We're going, so schools are back. People that have families, that have kids that are in school tend to make less movements around this time, but also we're heading into the holidays, and once that hits, it takes a toll on demand in general. So demand's going to continue to fall. So is the inventory. Inventory is falling, and it's going to continue to fall. Doesn't typically pick back up until mid-February or beginning of February, when things start inching up. But like from now until the end of the year, both demand and supply are going to fall quite a bit. So, honestly, my outlook on the market is pretty positive still, and long term we're going to see appreciation. We have strong fundamentals. Appreciation doesn't mean the rates of appreciation we had last year or the year before, because that was just crazy. But we're going to see the normal appreciation, which is sustainable, which is good. And if you are buying, I think it's still a good time to buy. It's good that the fact that you are negotiating on price, you don't have to waive all your inspections and appraisals and all this stuff. You don't have to pay over the appraised value. So all these things are positive if you are buying. And if you are selling, pricing all the way. You have to be very on top of pricing. Obviously the property has to look great, it has to stand out compared to what other properties are available, but pricing is key. If you overprice it and you stay on the market and you start chasing the market, it doesn't do anyone any good. The longer the property stays on the market, typically buyers start asking what's wrong with the property, and you don't want that to be the case. So if we can help you in any way, if we can answer any questions, feel free to reach out to us. We're always happy to help. And until next time.